Hi everyone, welcome to my channel. So in this video, we would be studying about arbitrage constraints on spot exchange rate. So how are arbitrage opportunities possible when a dealer quotes a spot and when a dealer quotes a bid offer quote for a currency pair. So in this video, we would be studying that. So whenever a dealer whenever a dealer sets a bid of a quote for a currency pair, he must satisfy two conditions. Two conditions must be satisfied, and if these two conditions are not satisfied, in that case there would be an arbitrage opportunity. If not, arbitrage opportunity arbitrage profit opportunity exists. So now let us understand what are the two conditions that a dealer must follow when setting a bid offer price. So the first condition is, there are 2 points in first condition. So the first condition is the first condition is bid the bid price shown by the dealer cannot be higher than the current interbank market offer price. So the first condition is the bid price shown by the dealer cannot be higher than cannot be higher than the current interbank market offer price. This is the first point of the first condition. Now the second point is the opposite of that. That is, the offer price shown by a dealer cannot be lower than the current interbank market bid price. So the concept always remains the same. Whatever the condition is, the bid price has to be less than the offer price. So the offer price shown by the dealer cannot be lower than the current interbank market bid price. So I'll write it in the form of an equation so that you can remember the equation later on. So always interbank offer interbank offer price, I'll keep offer price at one side. So always the interbank offer price should be greater than dealer's bid price. And the second condition is the interbank bid price, interbank bank market bid price should always be, one second, the interbank market bid price should always be less than dealer's quoted offer price. So whatever the condition is, the offer price should always be greater than the bid price. So that is the first condition. So the first condition is this formula. Now, what happens if this condition is not satisfied, or if this condition is violated in any case? If this condition is not satisfied, if this condition is not satisfied, then arbitrage profit opportunity exists. So now let us understand this with the help of an example. In this problem, they have given us USD Euro currency pair interbank quote and dealer's quote. So first let us check the interbank quote. So in the case of interbank quote, so the first price is always the bid price and the second price is the offer price. So in the case of interbank quote, the bid price is 1.1549 and offer price is 1.1551. So the bid price is less than the offer price. Interbank quote is good. Now the second quote, that is dealer's quote. If you look at dealer's quote, the bid price is 1.1552, offer price is 1.1554. Again, there is a 2 pip spread and bid price is less than the offer price. So this is also good. Dealer's quote is also, from dealer's perspective, it is fine. Now let us look at interbank quote versus dealer's quote. So we can check crisscross. So in this case, in the first case, we can look at interbank market bid price and dealer's offer price. So that is the first condition. So uh, I'll look at this condition, that is interbank market bid price should be lower than dealer's offer price. So if I look over here, interbank market bid price is less than dealer's offer price. So this point is satisfied. Now let us look at the other point. Dealer's bid price should be less than interbank market offer price. So dealer's bid price should be less than interbank market offer price. So in this case, dealer's bid price is 1.1552 USD and offer price is 1.1551 USD. So in this point, in the first condition is actually violated. Why? Because the dealer's bid price is greater than the interbank market offer price. Hence, the first condition is violated. That means that the first condition's first point is violated. That means arbitrage opportunity exists. Arbitrage opportunity exists. So how will market participants get riskless arbitrage profit? So what will happen is that in such case, market participants what will they do? They will first go to the interbank market. So the large institutional players, banks, etc., who have access to interbank market, they would first go to the interbank market and pay the offer. Pay the offer. So if the client pays the offer, it means that the client is buying the base currency. So in this case, the market participants would buy 1 euro, that is the base currency, 1 euro for 1.1551 USD. Each 1 euro for 1.1551 USD. Now, what will they do next is they will, the market participants will go to the dealer and hit the bid. So now what will happen is the clients will go to dealer and hit the bid. That is, they will sell the euro and dealer would buy the euro. So for what price will dealer buy euro? Dealer would buy euro for 1.1552 USD. That is the bid price. So in this case, the market participants would sell each each 1 euro for 1.1552 USD as per dealer's bid price. And so if you look here, the market participants would buy euro for 1.1551 USD and sell euro for 1.1552 USD. By this, they will make 0.0001, that is 1.1552 minus 1.1551, 1.1552 minus 1.1551, which is equal to 0.0001 or 1 pip USD profit fit. So this 1 pip USD profit is the market participants for each euro transactions, market participants would make 1 pip USD profit, and that is the arbitrage riskless profit. So there is no risk involved. They are buying from interbank market, they are selling it to the dealer and making a riskless arbitrage profit. So this is what happens if the first condition is not met. So if the first condition is not followed or satisfied, there is an opportunity to make riskless arbitrage profit. Now, what is the second condition? The second condition is the second condition that dealers must follow while setting bid offer price. The second condition is cross rate bids posted by the dealer must be lower than the cross rate bids posted by the dealer, yeah, must be lower than the implied cross rate offer implied cross rate offer available in the interbank market. So in the case of cross rate bids, the cross rate bids posted by the dealer must be lower than implied cross rate offer that is available in the interbank market. So again, bid must be lower than offer price. So cross rate bids must be lower than the implied cross rate offer available in the interbank market. The second point of second condition is the opposite of this one, that is cross rate offers posted by the dealer must be higher than, so offer price should always be higher than bid price, higher than implied cross rate bid available in the interbank market. So in this condition, it is the opposite, that is the cross rate offer that a dealer posts must be must be higher than, offer should always be higher than the implied cross rate bid that is available in the interbank market. So if I write it in the form of an equation because it is easier to remember, it would mean that the dealer's cross rate bid should be less than implied cross rate offer, and the second one is the implied cross rate bid in the interbank market should always be less than dealer's cross rate offer. So no matter what the condition is, the bid price should be less than the offer price. So this is the equation form of what we just studied. So now, before going to this condition, before understanding this condition, let us first understand what do we mean by uh, implied cross rate, and what do we mean by cross rate and implied cross rate, etc. So let us take an example. So a client example, a client wants currency quote for currency A by C. Okay, but the currency quote quote available is A by B and A by and B by C. Uh, available readily. The currency quote available readily is A by B and A by C. So in this case, what the client can do is, client can using the A by B and B by C currency quote. Using these currency quote, client can calculate the A by C currency quote, and this calculated A by C currency quote is known as implied cross rate. So it is not the actual cross. It is the cross rate that it is the cross rate for A by C that we calculated using A by B and B by C currency quote. Uh, Instead of looking at the market currency quote for A by C. So what we calculate theoretically is known as the implied cross rate. So one of the important thing that we should remember is the implied cross rate that we calculated. The implied cross rate calculated, that is the implied cross rate for A by C, in this case must be consistent with must be consistent with the actual market price for A by C. If not, then what will happen? So this is the basic principle of arbitrage. That is, if we calculated the cross rate for A by C using A by B and B by C, then the calculated implied cross rate must be consistent with the actual market price for A by C currency. Now, if this is not satisfied, then what will happen? Arbitrage opportunity exists. Arbitrage profit opportunity exists. Opportunity exists for market participants. Because then the market participants would sell the cheaper currency and buy the expensive one and make an arbitrage profit. We will deal with an example for this in the next video. Like after we understand how to calculate the cross rates, implied cross rates, in the next video we will solve a triangular arbitrage question. So now this is the concept. The implied cross rate A by C must be consistent with the actual market price for A by C. That is, calculated A by C must be equal to the actual market price for A by C. If not, there is an arbitrage opportunity for market participants. We can now solve an example to calculate implied cross rate. So in this example, they have given us the interbank rate for Indian rupee to USD. INR to USD is equal to 94.9650 bid price and 94.9652 offer price. And USD to Euro bid price is 1.1509 and 1.1551. So we have to calculate INR Euro implied cross rate. So if you look, we have INR to USD and USD to Euro, and with this we have to calculate INR to Euro. So in simple mathematical terms, how can we solve it? To get INR to Euro, if I use INR to USD cross rate, INR to USD quote, and multiply it with USD to euro quote, I should get INR to euro quote because the USD will get cancelled and it should give me USD would get cancelled and it should give me INR to euro quote. So, an important equation that you should always remember is for a currency pair A by to get A by C's bid price, it would be equal to A by B's bid price into B by C's bid price. So what will happen? Both the B's would get cancelled. We'll get A by C bid price. Similarly, to get A by C offer price, we should take A by B's offer price and multiply it with B by C's offer price. So again, B's would get cancelled and we'll get A by C offer price. So this is an equation that you should remember. With this, you can easily solve such questions. So now, based on the above equation, let us solve. Uh, let us calculate INR euro bid price and offer price. So INR euro bid would be equal to INR to USD bid into USD to euro bid price. So in this case, INR to USD bid price is given as 94.9650 and USD to euro 1.1509. So it would be 96.9650 into 1.1509. If I multiply it, I'll get 109.2952. So this would be the bid price. Now to calculate INR euro offer, same, I will take INR to USD offer, multiply it with USD to euro offer price. So what is INR to USD offer? INR to USD offer price is 94.9652 and USD to euro offer price is 1.1511. So I will multiply 94.9652 with 1.1511 and it would give me, one second, 1.1511 and it would give me 109.3144. So with this, the INR euro, the implied cross rate for INR euro is first the bid price, that is 109.2952, 109.2952, and then the offer price, that is 109.3144. So here if you look, the bid price is less than the offer price and this is how we calculated the INR euro implied cross rate. So we understood how we calculated INR euro implied cross rate. Now if you want to understand how we calculated this formula, that would also be discussed in the next video. Now let us continue with another equation that we should always remember. So let us now move forward to learn another equation. So in this case, we have been given with the interbank rate. One minute, interbank rate for USD to Euro and USD to GBP. So USD to Euro is 1.1501 and 1.1511, and USD to GBP is 1.3332 and 1.3334. Okay. So now using these, I have to calculate GBP to Euro implied cross rate. So for GBP, for GBP to Euro implied cross rate, which are the other currency pairs that I require? So to get GBP to Euro implied cross rate, I should have GBP to USD currency pair and then USD to Euro currency pair. Sorry, this app is making straight lines, though I am trying to show division equation. So GBP to Euro should be equal to GBP to USD and USD to Euro, so that USDs can get cut. But is it the equation that we have? No. Instead of instead of GBP to USD, instead of this equation, we have been given USD to GBP. So how can we convert? So now what will happen is we have to convert USD to GBP into GBP to USD prices. That is bid price and offer price. So how can we do that? So in this case, I'll take uh, the required equation, required currency code to the next page as well. So now I have USD GBP currency quote. So now to calculate GBP to USD bid price. How can I get GBP to USD bid price from USD to GBP currency pair? So the formula is GBP to USD bid price would be equal to 1 by USD to GBP offer price. Similarly, GBP, why is that? Now let us just understand why is that happening. So in this case, I'll take an example. So if I want to buy 1 GBP, to buy 1 GBP, if I want to buy 1 GBP, what will happen? I have to use, I'm a client, not a dealer. So if I want to buy 1 GBP, I will go and hit the dealer's bid or the interbank bid. So in this case, I use GBP to USD bid price. Okay, so, with which I can this GBP to USD bid price, what is it? the price at which seller buys 1 USD buys USD and sells GBP. So in this case, if I want to buy GBP, I'll use GBP to USD bid. Now similarly, using this equation, if I want to buy 1 GBP to buy 1 GBP, what will happen? In this case, to buy 1 GBP, I have to pay the offer. Pay the offer because that's the price at which seller sells 1 unit of GBP. So in this case, I have to pay the offer. That's why when I want a similar equation, that is when I want GBP USD bid, using USD GBP bid, I have to use the offer price instead of the I have to use the offer price instead of the bid price because I wrote it on the other equation. Yeah, because to buy 1 GBP using this equation, using USD GBP currency pair, to buy 1 GBP, I have to pay the offer. That is, I have to uh, take the offer price to buy 1 GBP. That's why when USD GBP equation is being used to get the bid price, to get GBP USD bid price, I will use USD GBP offer price. So GBP USD bid price is equal to 1 by USD to GBP offer price. Now, uh, so I'll write it down. If I want to buy 1 GBP, I need to pay the offer for USD GBP. The offer. Okay, so that's how I use offer price over here instead of bid price. Now, once I get the offer price, if I have the price 1 by the offer price is how I can convert USD GBP to GBP USD. That is mathematical equation, like mathematical equation 1 by USD to GBP. Using maths, this GBP should go up. It will give me GBP to USD. So that's how this equation comes into that's how this equation is formulated. So using this equation, I can calculate GBP to USD bid. So GBP to USD bid would be GBP to USD bid would be equal to 1 by USD to GBP USD to GBP. I don't know, USD to GBP offer. So it would be equal to 1 by USD to GBP offer 1 by 1.3334. 1.3334, which would give me 0.7, 1 by 3334, which would give me 0.7499. Similarly, GBP to USD offer would be equal to 1 by USD to GBP bid price, which would be equal to 1 by USD to GBP bid. USD to GBP bid is 1.3332. 1 by 1.3332, which would be equal to 0.7500. So GBP to USD bid and offer comes to be 0.7499 to 0.7500. So with this we calculated GBP to USD bid and offer price. Now if you take the now if you go to the question, I have USD to euro bid price and offer price, and with that I can calculate GBP to euro. So if I go, so now with these two equation I can easily calculate GBP to euro, because GBP to euro bid price will come to be GBP to euro bid would be equal to 0.7499, that is GBP to USD bid, into 1.1509, that is USD to euro bid. Both the USDs get cancelled and I'll get GBP to euro, and GBP to euro offer would be equal to 0.7500 into 1.1511. So if I do the multiplication, one second, 0.74 for GBP euro bit, 0.7499 into 1.1509, I'll get 0.8631, and in the case of offer, 0.7500 into 1.1511, it would be equal to 0.8633. So the bid price and the offer price is GBP euro. If I write it as a currency pair, it would be 0.8631 to 0.8633. The bid price is less than the offer price, and this is how we calculate the implied cross rates. So once you know this equation, that is, once you know that GBP by USD bid would be equal to 1 by USD to GBP offer and GBP to USD offer. So once you know such equations, that is this equation and this equation, so instead of GBP to USD, you can write it down as A by B is equal to 1 by B by A, like that. That is, once you know the equation, that is A by B bid price is equal to 1 by B by A offer price, and A by B offer price is equal to 1 by B by A bid price. So once you know this equation, instead of going the long route, you can easily substitute this equation. So here, instead of writing, so instead of going and finding euro, GBP euro bid and GBP euro, instead of finding GBP USD bid and GBP USD offer separately, you can use this equation directly into the GBP euro bid and GBP euro offer equation and find the uh, implied cross rate directly. So this is the important equation that you should remember. So with this, we have learned how to calculate implied cross rates. So the conclusion for this video is the conclusion is the bid price is always less than offer price in every case. Like if you get cross rates, if you get interbank rate and dealer's quote, no matter what the situation is, all the bid prices should be less than the offer price. The the second conclusion is our arbitrage opportunity disappear quickly. Why is that? It is because trading algorithms and human traders, like usually they can quickly spot the arbitrage opportunities because computer algorithms will quickly calculate the implied cross rate and the difference with the actual cross rate and quickly do the trading transaction and make arbitrage profit. So because the huge volume of buying and selling would take place, the arbitrage opportunity will disappear quickly and bring the prices back in line. Now the third conclusion, so this is not conclusion, this is like some of the points to remember, some points to remember. So the next point to remember is usually market participants don't need to calculate these cross rates, implied cross rates, etc. manually because computers, electronic machines can do it quickly. Participants mm, do not calculate manually. Electronic machines can, like computers can quickly do it. Computers, trading algorithms quickly calculate and uh, quickly calculate the implied cross rates. So then why are we studying it? It is because we should understand what implied cross rate is and how it is calculated, right? That's why. So that's all for today's video. I hope you understood what was taught. In the next video, we will solve an example. Thank you.